Hello, everyone, and welcome, and a belated Happy New Year. In 2024, returns were strong across stocks and bonds, but push out to 2 years, and the S&P 500 produced its highest return since the go-go 90s. And while we're here, note high yield, something we've talked about for a while, up 23% cumulatively. But zoom in on just the last 3 months around the election, and that is a different story. Challenged markets, particularly within bonds, reflected the question in markets today: how to marry current conditions to potential policy. Look, I know it sounds simple, but my take is to first focus on the current state of the economy and markets. That's hard enough. Then filter it through the potential impact of policy and see where that leaves us. So let's begin with the Trinity: growth, the labor market, and inflation. Growth is moderating from a place of strength. That's captured really well by the household paycheck proxy, which in turn is reflected in the Fed's consistently solid growth expectations. And since the driver of the paycheck proxy is labor, it's the same data story from jobs added and job openings, solid and moderating to trend. And here as well, the Fed has been pretty consistent on unemployment rate forecasts, but the Fed has also been clear of its concerns of further weakening. Here's a little contest for you. Keep an ear out for how often Federal Reserve members use the word cooling, as in concerned about too much cooling when it comes to the labor market. Keep that in mind for a moment as we move on to inflation, which has fallen significantly from its COVID highs, and though close, I mean tantalizingly close, remains above target. Amongst the 4 headline categories, food, energy, and goods are back to pre-COVID norms. The culprit, of course, has been services, and within services, the dominant driver has been shelter costs. But even there, more recently, we've seen it coming down in the data. And yet, despite the fact that it appears as if inflation is poised to come down further, the Federal Reserve has increased 2025 expectations and has taken the number of rate cuts down, which brings us squarely to the potential impact of policy on prices in the Fed. And it's not just the Fed. Market estimates ping-ponged throughout 2024. Look, as a starting point, we do have recent history as a guide for tariffs and inflation. The first Trump administration tariffs increased prices, which increased inflation. But, and this is a big but, since it was effectively a one-time bump, it exited CPI a year later. And importantly, inflation expectations, the boogeyman of central banks, didn't move. Tariffs then, for the most part, were also between just the U.S. and China, with some other asides. The big question is whether or not this is a similarly contained experience, or if it becomes much more involved and multi-party. If more like the former, the impact could be very much like we saw. If the latter, it could take years to play out and make the economic impact more complicated. So, if we try and put all of this together, we have the economy cooling back toward trend and inflation a bit higher on the back of policy. By the way, the rule of thumb is a 10% tariff equates to a 1% inflation bump, with 3 rate cuts on the back of a Fed that we believe, should inflation expectations remain well anchored, will be protective of that so-called further labor cooling. And as investors, first for bonds, the thought is back to the future, and that's 4 things. 1, real yields are elevated with some number of rate cuts coming. As an investor, the opportunity to lock in real yields at that level is still very material. Secondly, bonds globally will not be moving in lockstep. Divergent monetary policy means varied bond opportunities throughout the world. And number 3, the return of positively sloped yield curves. Yes, I'm excited. We've lived in inversion for quite some time, but somewhat quietly, the curve's been assuming its normal shape. As any card-carrying bond geek, that would be me, will tell you, that opens up roll and carry, effectively a gain in a bond's price as it ages to lower yields down the curve. And lastly, credit remains attractive. I mentioned high yields 2-year returns. Yields today are still attractive at 7%. They are historically predictive of forward 5-year returns, and fundamentals and technicals remain well supported. In equities, the dominant theme for some time has been historic concentration in U.S. large cap stocks and the expectation of a broadening out of returns across stocks. If you squint really closely at this line, we saw some healthy broadening out recently, only to see it retreat in the 4th quarter to the warm embrace of the Mag 7. However, we still believe that heavily concentrated U.S. large caps, just as it has historically, will broaden. So, putting it all together, if I combine fundamental conditions, relative valuations, and the impact of policy like tax cuts, deregulation, potential onshoring, etc., that suggests areas such as value, large cap quality, dividend growth, small cap stocks. Look, in the end, I believe there is performance potential in policy, also in the macro backdrop, and in the concentration that's there for us to take advantage of. It's going to be bumpy, but bumpy classically means opportunity, especially as concrete policy takes shape. There will, of course, be much more to come on this throughout the quarter and beyond, but for now, thanks for joining. I wish you a happy and healthy 2025, and we'll see you next quarter.